we're taking a view on London and the investment opportunity here, but also going to be tackling some of the dynamics in the markets as well. So I'd like to invite my panelists to the stage: Richard Hatch of Berenberg, John Wong of Ruffer Funds, Gervais Williams of Premier Miton, and James Wood of Winterflood Securities. Gentlemen, thank you. So look, why don't we start? How are we making sense of the markets at the moment? That's the sort of $1 million question. And there was a lot shared in the panel this morning as we opened up, a lot around the macro, etc. I think we're going to hone into some of the UK London-centric issues here, but we have a wealth of experience on the panel. Let's focus in on how we're reading things at the moment. Gervais, you look like you're ready to jump in as ever. Please.
Yeah, I would like to come in, actually. I mean, we all think of the UK market as fairly sort of tired and struggling a bit here and there. But actually, during the period of globalization, you have been able to get extra growth around the world and more debt in private equity and all these other exciting things, which have been brilliant. But actually, over the last 2.5 years, the FTSE 100 is pretty much the best performing stock market, bar none. Right? So that's kind of quite a big surprise, because a lot of people think it's still pretty boring. No, it's a little less boring now. It's slightly outperforming. And even more remarkable for me, as an investor in the UK, it's outperformed just about every other stock market in the world at a time when UK local redemptions, OIC redemptions, have been near record levels pretty much for the last 18 months or 2 years. So you've got nearly everyone selling, clients, they've said, I've got enough of the UK, it's underperformed for so long, I don't want any more, etc. It's had a little bit of a peak up, we'll just knock it out again. And in spite of that, it's still outperforming. And I think that's down to two factors. I think one, the UK market isn't like most other global markets. It's mainly equity income stocks, mainstream stocks, and therefore you've got stocks in the mainstream equity income stocks which are low beta. Nearly everyone's got far too much high beta, and so basically they're just having to reweight. International investors, they're not buying the UK. They don't really want to buy the UK. They're just buying equity income, global equity income, which means they put a load of money in the UK. It's the first point. The second point, and this is very much back to the home turf, is that actually, unfortunately, we've had the same redemptions in small caps at no international buyers, strange enough. So you will have noticed that your share prices have been under massive pressure for the last 2 years. Literally, the AIM market's underperformed the FTSE 100 by 55% in the last 2 years. That's a massive number. Even 20 or 30 is a big number. 55 is crazy. But if my view is that the UK market continues to be pretty much the best performing market in the world for the next, say, 10 or 20 years. And I think small caps absolutely return to their former position, which is outperforming the mainstream market. So you may think it's awful. There may not be much to look forward to in the next month or two, but don't give up your listing. It's going to be one of the most valuable features of your business.
Yep, excellent. People were saying this morning is a sort of a 6-month risk-off period at the moment. Some of the investors commented. Would you subscribe to that in terms of your forecast for the small caps picking back up again? Are rates really slowing things down, and that we should, when is it going to get better? Is for the small caps? That's what I
mean. To get better, all it needs is that the OIC investors need to stop selling less. It's a really small. That's a low hurdle. That is right. So a little less selling because it's outperforming so much. Perhaps I think we want the government basically to start saying we don't want our companies to relist in the US and other places. So basically they need to inject extra fuel. My own view, and Woody and others have heard this, is basically we should actually ask the government to insist that for the next 3 years, 80% of your ISAs go into UK quoted companies. That will transform share prices in a few days.
Is the sell-off not happening because people need the cash? Rates are, mortgages, everything. People need to sell off where they can. I'm just playing devil's advocate here.
Yeah, I mean, and you say that, but I mean, obviously, share price has been going up for the last 6 months, so it's obviously so bad for the mortgages. Somebody's been putting money in somewhere, so I don't subscribe to that view.
Okay, great. Anyone else for a state of things now with a UK lens? Let's start with that.
Yeah, I mean, look, from a broker's perspective, I mean, the most traction I get in my coverage is gold. You run a gold fund, you've got some gold stocks. I mean, Woody, you do it as well. But I mean, we get a lot of interest for some of the gold names. The challenge in London in particular has been that some of those names haven't been particularly great performers. Fresnillo's had some tough years. Endeavour's been quite a good story. It listed on the premium segment of the FTSE. It's done a good job. Liquidity starting to pick up, but quite frankly, a lot of the smaller names are quite illiquid, and therefore, if you're looking for a gold exposure, then perhaps you'll go to Canada or to Australia, where the number of companies is broader. I still think that London's got a big role to play, but with the liquidity tight in the smaller end of the range, it becomes a bit harder to sort of push those names. So we get most of our traction on, like an Endeavour or a Sentiment or something that's got a bit of traction and trades a bit in the market. Whereas if you're trying to push something that's a bit more illiquid, even though it's a good story, cheap, good free cash flow, investors kind of look at it and say, look, I want to get in and out rather than have to sit in this one and be a value trap. I don't know what you'd say to that.
Well, I personally wouldn't buy a lot of illiquid stocks only because I have a limit. These days, my firm is being run by my compliance team. So there are some limits to what I can or cannot do. But for me, personally, I'm a value person. So I would do it if I thought it kind of justified the discount, if you like. But to agree with you, I think in the mining space, I can't speak for the general UK, I know that there's not a lot of fresh money in the space. And I can feel it. I can feel when there is liquidity coming in, there isn't. And I don't know if that is just UK, which I don't think it is. I think globally there's not a lot. Maybe there's some money going in the US, but definitely not here. I don't feel in Europe. And I don't know if the Aussies have got a lot of firepower either.
Lots of talk around the Inflation Reduction Act and that eventually maybe coming upstream into the mining projects is certainly helping with the on the tax front or on some of the discounts that you can get on project financing side, and early signs it could convert into more capital and maybe also just approve permitting quicker, just because you've got this policy behind it and there's a European equivalent. But that means that the US is ever attractive in that respect. Do you think things like that are really boosting mining there, as opposed or in Canada, where you've got this North American play? What could attract miners back to AIM?
Well, I think AIM, it goes in cycles. I think there's, Australia seems to be pick of the month at the moment because they've got lots of local projects that people understand, and the retail investors are very active there at the moment. And that's a cyclical thing. Canada seems to be probably more dead than London. So what attracts anybody to AIM? There's lots of moves at the moment. We've been talking about various panels away from here to attract corporate entities to listing on AIM and making the listing rules easier and more easy to navigate. I think generally retail investors have been somewhat fatigued in this particular sector because nobody quite knows how much they've lost in crypto or in cannabis stocks or whatever, which probably has affected a lot of Canadian investors, probably more than here. But what's going to attract people back to London is ultimately, if you're going to list, it's where the money is. And if you're an Australian company with an Australian project, then there's no need for you to come to here. But if you're a company that's got an African project or even a Canadian project at the moment, I think then London is probably closer to home and the place that you'd want to. But it's got to be a good project, and it's got to have the right metrics. And at the moment, there's this perfect storm of this demand curve that everybody talks about in whatever rare earth or whether it's gold or whatever. There's this huge demand curve, but no one knows how much it's going to cost to build a project anymore. And the cost of building a project's just gone up 40% this year from last year. The cost of getting your bank financing in terms of your corporate cost of having to hit every single ESG box that you've got to tick for any bank to even think about lending to you, as well as equity investors that also have their own list of tick boxes. It's almost becoming too much of a barrier to even promote a project to investors because, if you're a small cap, you haven't got the money to go and spend on a whole load of other things, and you've got to articulate everything in the right way in order to get any project off the ground. So, and ultimately, you've got to have an end game. And one of the first questions I ask to a company is, "What's your end game?" And if your end game is to go and sell it to a bigger boy, then fine. But all the bigger boys at the moment, their investors seem to want dividends rather than actually going and spending the cash on making acquisitions or funding someone else's project and doing a joint venture. So there's lots of dynamics, but I agree with Gervais in that London is incredibly cheap at the moment. I'm looking at gold producers that share price hasn't moved in a year and they're producing gold at record margins and paying dividends.
Yeah. But so how do we break out of that sort of cyclical rut? Is it the majors and the dividend payers finally getting the chance to do some M&A or maybe stick some capital back into exploration? Or is it people waking up to this sort of value opportunity where the companies are, incredibly cheap relatively, or is it this new capital that we always talk about at this show? Where's it coming from?
I think we're too negative. Don't get me wrong. I think markets can go lower before they go up. I'm not sure. Nobody's going to be certain where the market's going to move in the short term. But coming back to this specifically, you many of the businesses here may feel you're not having a great time of it. Your valuation's low, etc. But if you're an unquoted company, things are a lot worse, right? So you're in the relatively box seats compared with others. And if things continue to be tough, and I think they will for a while, then many of those projects, which might be quite on the cusp of coming into production, they're just 5 or 10 million short before coming into production, may go bust. Now the opportunity for a PLC is to chop along to see people like me and John and others and say, would you believe it? We've got our current project, which is just going fine, but we were able to buy this project from the receiver for next to nothing. All we need is another 5 or 10 million, perhaps 20, to get it across the line. Cash payback is 18 months. Who's up for it, right? So let's not get too negative. The second feature about ESG, I think, is actually easy to characterize. When we're investing in many of the major companies around the world, us and many others, basically we have nearly no equity. We've got, a tiny percentage holding, right? And the boards of these companies, the directors and the management, they can't see everyone. They've got tens of thousands of investors they could see, and they're not going to come and see us, to be honest. They're not going to see many of the major houses. They'll see some of the very largest shareholders who've already got a big holding, but if you're not a holder, probably won't see you. So coming back to it, your opportunities for engaging with these companies and making a difference is very limited. Of course, it's the exact opposite at the small cap end of the market. There are only a few investors which are willing to invest in small caps, and many of you companies are happy to come and see us all, even if we're shareholders or not. Right? And of course, if there are things which we can say, well, if you did that, you'd make yourself more attractive, or you tick that particular box over there, then you might bring a whole lot of capital in. So basically, we can have lots of influence. The opportunity for having an ESG influence going forward is hugely better in the many of the mining companies than it is in many of the mainstream companies, and that's even more the case in small micro mining companies. If anything, micro mining companies have a real sensitivity to this issue. You've been worrying about ESG before it became called ESG. You knew if you were operating in a country and unfortunately safety went wrong, you had a lot of deaths in your mine. The chances are the local guys will just come around and say, "Terribly sorry, we've decided to take it on. Your mandate's been withdrawn." So coming back to this is an area which you already excel in. So again, I think it's all too easy to get too negative. I'm extremely optimistic over the next 3 and 5 and 10 years that many of your businesses will see a sea change, and you'll be able to generate returns, raise capital at lower and lower cost of capital, and that'll enhance your returns further.
Yeah, look, I mean, as an analyst, so I think, I'm very optimistic about what my coverage universe looks like. If you look at the longer term demand profile, it is actually really good. The problem is in the near term, just that pull from EV demand or wind demand isn't actually translating into physical metal demand, because it's all being a bit delayed because it's Western governments pushing it rather than a communist Chinese government that drove prices up in the last cycle, but still prices are high. I think for me, we were just talking earlier on about Rainbow. Rainbow Rare Earths raised $9.5 million this morning, decent premium, but they had to go to a cornerstone investor to go and get it done. Would the market have been there for a larger raise? Maybe not. But it will require patient capital to let that thing go, then prove up the pilot plant, then let it fly, and then perhaps some more investors will come in a bit further down the line when it's de-risked on a bigger ticket. But and there's a load of coverage in my coverage that trading at 0.2, 0.1, 0.3 times NAV, good projects, decent jurisdictions, but just struggling to get finance. And, they're going to, people like you guys, but also, your private equities like your Orion and, deeper pockets, longer term patient capital. But that's the kind of where we're seeing sort of a lot of capital flows going at the moment. But yeah, I mean, sadly at the moment, London doesn't feel like the place where there's a lot of capital going in. But also I'd say the interesting thing about this time around versus the last time is that a lot of those interesting names that were really good stories haven't really sort of materialised. There's not loads of them. There's a few, not loads. And I think it's because firstly, you haven't had a lot of money going into exploration. So, those things haven't been coming along the curve. And then secondly, quite a lot of those sort of mid-cap companies have been taken out, your CAS Minerals and things like that, which would have been quite a nice, good name to own at this point of the cycle, is gone because of corporate activity. So and I think there's more interesting mid-tier names in either Canada or Australia than we have got at the moment, I'd argue. Sorry.
Yeah, no, it's good. And the companies you're saying that were sort of good, posting good financials, but struggling to raise the capital at the moment, sort of development stage, proven projects, but not in production, or are they earlier stage? You're talking like exploration.
No, they're development stage, so they're either PEA, PFS, DFSE kind of level. Rainbow's sort of through PEA. You've got Sovereign Metals, which is a mineral sands developer over in Malawi. There's quite a few. They're good companies, but it's just getting that that 10, that 20 that has to come in the door just to fund them through to DFS and then or post DFS and then into financing. But then Peak last week raised over 20, I think it was, to take it through post DFS, and that's them funded to their final investment decision. So look, there's money around, but it has to get either done at a discount or it has to go to a slightly left field or cornerstone investor who's willing to just take that position and place it. Because I don't know, would you buy something at 28% premium?
No,
maybe. No,
28% premium. No. So, look, it's in my view. This is hard to explain, but I think capital is just very, very tight in mining. I can't speak for every other sector. There may be some sectors where money is flowing, which is possible, but in mining, it's really hard. There's not a lot of new capital in the space, and I think it's also not a trendy thing to invest in. Just generally, my younger colleagues at work definitely look at me like I'm some alien investing in mining when all they want to invest in is in tech. It's ESG friendly. They love that kind of stuff. They look at me like I don't care about the environment and, that kind of stuff. So the young guys don't like it. They want energy transition, but they're not thinking how we're going to get there. So that's the dislocation. And the returns aren't great right now, if we're being honest. Right? They're not great in the sense that if it was that easy and the returns were amazing, money will pour in. But if they've been losing money and investing in mining every year, it's a big ask for people to keep coming back for more, right? I mean, you can only get punished so many times. So I think all these things make it a tough place to be. That's not to say that it wouldn't change. I personally think that it will change. But it'll change for different reasons because price is everything. If the price of copper, say if there was no new supply, copper price will get to a level where there will be new supply. So I'm very, very confident that it will reverse itself, but in the way that the commodity prices will eventually sort themselves out. Short term, it's going to be very volatile because until we get a high enough price to incentivize new investment, we might not get it. That's why I find it difficult.
Didn't we get that a few years ago when the prices were booming and it sort of just didn't sustain? We sort of plateaued a bit now based on as rates killed everything.
Look, there are different things in mining and different commodities are different. So some commodities are what I call short cycle. You can get a very quick response. If the price is there, you can get a lot of metal very quickly, and others are long cycle. You got to invest for 10 years before you get any new supply. And it wasn't long enough to induce the long supply. Yep. And there's some metals which may be reflected in the short-term spikes, but not really.
What about gold now, though? Obviously, it has a very different function. That gold price spike hasn't reflected in the equities yet, but they tend to kick after. Are we going to see
So I think gold
gold's
is
changing there?
the structure for gold has changed a lot. Okay, so if I think about investing in gold 20 years ago and today, it's like night and day. And the real differences are these. So if I summarize the big moves, the creation of the gold ETF is a big deal. So if I want gold and I don't want to take any operational country risk, jurisdiction risk, management blowout risk, I'll buy the gold ETF. If I thought it was going to go up and I want to leverage myself 50 times, I knock myself out. Do you know what I mean? Like I can just do that. So that's one big factor. The liquidity in the ETF is unbelievable. You can buy $100 million like that on the clip. So that's one factor. Then the second factor is all the mining indices, like the GDX, GDXJ, and all these big cap indices. That's actually messed around with the allocation as well. So if I want gold exposure, and I don't know about a junior mining company, let's say I just haven't done any research, but I'm very bullish of gold, and I didn't want to buy the gold ETF, I'll just buy one of those indices. And I, again, can allocate 50 million, 100 million like that, just like that, and it's done. And I don't know anything about the companies I invested in, and they'll just do the same thing. So I think these proxies have eliminated the requirement for people to do a lot of work. And because active fund managers like me are not getting allocation, okay, and maybe as a peer group, please forgive me if this is you, we have underperformed maybe, okay, then that doesn't incentivize people to give active money. Just go with passive money. So when will the small caps get an interest? I think the initial interest will come from retail. Okay, so if the retail guys go in, let's say I'm making numbers up just to kind of illustrate the point. Say if gold went to 2,200, 300, 400, we get onto all the headlines. The retail guys are like, hey, wait, I remember a company called Sentiment. I'm going to open fire. And these guys push it. So they start to outperform. All the active guys will start to chase because they're kind of like, do you see what I'm saying? And that then starts to outperform the general index. And then everybody's like, let's give the active guys some more money. And that will kick the cycle. But I think we're a bit far from that short term.
Okay. Yeah,
I'd agree with that. I think what moves a lot of the companies here, the small cap shares, is retail. And obviously we do, the other side of my firm does an awful lot of the volume in retail, about a third or 35-40% in the London market of retail. And it is extraordinary how once you get a movement in the right direction and gets a little bit of momentum, then it's like the wave is extraordinary. And we act as a sort of an intermediary almost between institutional investors and retail. So we're matching up and working institutional orders with the retail flow that we get. And it is enormous. And once it starts getting it, and you've seen it in all these cycles, whether it's, we were talking about crypto and cannabis stocks and all, we saw it all there. And mining's absolutely that, because everybody knows the direction of travel for all these rare earths that no one had ever heard of 5 or 6 years ago. And retail is well aware of it as well. It's just, they just need that catalyst. And once it starts, and trust me when I tell you that as a market maker, we tend to be long of most of the stocks that we quote every stock on the London market, and we're long of most of it. Not by luck or judgment at the moment, because we haven't seen a buyer for ages, as you alluded to in the AIM market. It's been horrendous. But because we're long, we actually want stocks going up. We want to sell a bit and mark them up, sell a bit more and mark them up. Not as the market perceives you, as soon as we've sold a bit, we're short, and then there's a bear squeeze. It's not always the case. Perception and reality are two very different things when it comes to trading small caps. So, and if things are going up, whilst market makers are often blamed for the share price going down, because we bought them and we haven't said, and we've bought them, the last 20 trades have all been sales. When the reverse is true and you get 20 buys, we never get thanked, but actually we might be marking them up because it suits us, because we've sold a little bit and we want to sell a bit more higher up.
Is that a misconception of the London market
a
makers?
massive
And there's sort of
misconception.
a split. Not all market makers are equal.
No, they're not. I mean, there's probably only 2 or 3 market makers that commit real capital to market making. Most of them are there just, they buy 10,000 shares and they immediately offer them out. And that in itself prevents a stock going up, because they're constantly in the offer as soon as they bought it, because they've got no capital to commit to the market. There are a few, I think, that do, and us and Peels and Berenberg, but there's 1 or 2 that will commit capital because it's all we do. We obviously commit all our capital to market making, but when things move, they will move, and they will go better, and that in itself creates its own momentum, and that's when you can have a real sea change.
This is very London centric in terms of that process as well.
It is, because
the other exchanges,
all the other exchanges in the world have an order driven system rather than a quote driven system. And it's a little bit of, it's very misunderstood in North America and Europe and Australia, because we don't have this market making system over there. So it's the good and the bad of the system. It kind of, if you're trading sentiment, you don't need a market maker system. It's a very, very liquid stock. If you're trading Anglos, you don't need a market maker. There's just thousands of orders on a minute by minute basis. But if you're trading Ariana or Rainbow Rare Earths, you do. And even if it's just as a reference price of, there's 6 or 7 market makers all making a spread, and then the retail investor asks the price on an electronic system that the market makers sign up to, and that electronic system, we might be working an order for Ruffer or for Miton, and therefore you're trading in the middle of the spread, and people don't understand it, and then they start to sort of think, oh, if you're trading in the middle, that must be a seller, when actually it might be a buyer. And people sort of misinterpret and try and, but it means that you constantly got a price. Whereas in some of the overseas markets, and you see these companies go and list their shares on, TSX, and they wonder why there's never any volume there, or Frankfurt, and they wonder why there's never any volume. Well, it's because there's no quote. There's no one actually making a price. And if there is, it might be an order that's at a cent or $10, and completely not representing what they actually are trading at. So London is misunderstood, but it's also the secret sauce of, when it works, it's very, very good.
Yeah, fascinating, excellent. Richard, do you have any other points to add to that?
No.
Very revealing.
No. I mean, I think you've sort of summed it up really well. I mean, that is just the nature of it, really. I mean, it's. I mean, we have seen some companies either add another listing or a dual listing to pursue other pools of capital elsewhere. So, Greatland's a good example of it. London listed, going on to the ASX to try and get some capital. But really, it sort of comes back to where the liquidity is. And if if the shares are trading here, then that's where the funds will buy that stock.
Do you want to jump in there?
Well, I wasn't. I think obviously markets are liquidity. That's the cornerstone of markets, and so it's easy for people to talk about big caps. Big caps are really dominated investor returns pretty much for the last 30 years, and so we've seen capital move out of UK because it's underperforming, and it's not moving into a multi-cap, which comes out of the UK. It moves into a mid-large cap overseas. And really, after 30 years, nearly all portfolios have got too much bigness. They've got lots of correlation, and they might have, some international companies which look quite similar to some of the local companies, but they're all big, and even the most small cap investors have actually migrated up to the mid caps. Mid caps have outperformed most of the small caps and micro caps in share price terms. Certainly, I mean, the mid cap index has been one of the best performing indices, even compared with things like Nasdaq. So there's most mid cap investors, have basically moved up from small cap. So going forward, of course, if things change, I think inflation changes everything. I think then you do find that actually suddenly the valuations of assets, which have been super normal, really, they've been bond yields near nothingness, some negatives, etc. Well, they're going to moderate as inflation becomes more of a persistent problem. And then on top of that, profit margins, which have also gone to crazy levels, they nearly touched 20% in the US last quarter. So basically, they're going to come down as well. So we're going to get moderating, valuations, moderating profit margins, loss to profit warnings, of course, to come. And as a result of that, all those people who are in these mainstream stocks, I think the stock market will probably go, I'm talking about global stock markets here, not so much the UK stock market. Global stock markets, I think, will pretty much flatline for the next 10 or 20 years. Right. So you can have as much index as you like, you can have as much ETF as you like, but basically you're condemned to nothingness. How are we going to generate return? And that's where active managers, but actually you guys come in and actually start to generate a return because you can buck the trend. I mean, I don't agree with John about the valuations. I think the valuations are low, but you don't need anything more. If you've got a company on a P of 3 or P of 2 or even the odd one on P of 1, generating cash with net cash in the balance sheet, you don't need anything to change. To be honest, you're absolutely in the box seats. One way or another, you're going to make plenty of money, whether it comes through in them buying shares or paying dividends or taking over something. You're just laughing, really. So from that point of view, nothing needs to change. I think it will. I think nearly all mainstream investors are going to find that they're just correlated into all this kind of high volatility stuff. And they're going to say, we need to get away from that. We need to buy some low beta stocks like UK equities, which I think they're buying, not because they're UK, but because they're low beta equities. And then you get the money waterfalling down. And it won't be the mid caps which outperform, which are absolutely overweight in nearly all UK portfolios. All the big cap guys have lots of mid caps. All the small cap guys are absolutely loaded with mid caps. They're overweighted. There'll be natural sellers in these, and they'll move down the market cap range into the small caps, into the micro caps. The best performing part will be UK micro caps by an absolute mile. And you can tell that from the valuations now. They're incredibly low, right? So don't think about how awful it is. It is awful, and it might get worse. I'm not saying it's going to get better straight away, but I'm saying it's already glorious, right? And it's going to get a lot more glorious, and you've got a lot to look forward to.
Good.
I'd agree. I was chatting to one smaller microcap peer of yours just last week, and and he's trying to pick up some of this very, very cheap stock, and his view is, he said, the trouble is, he said, I need a unit size of X amount. He said, but if I don't at least try and dip my toe in the water, he said, the worst thing that can happen is they go up, and I've got a little bit of something that's doubled or up 30-40%. And I thought that was actually quite an encouraging attitude of if I don't try, I won't get in, because some of these companies don't need money. They are producing cash. They are on PEs of 1s, 2s and 3s. And he said, so, if I'm going to be the one that bites the bullet, the trouble is that, he said, I just want to buy them as discreetly as possible while nobody's looking. Which obviously we try and help with. I'm sure you guys are trying to help with.
But where are we talking within resource companies here? Like, because you're generalists, and are we talking mostly in natural resources and energy, mining as well?
I think it's probably pan sector. I think particularly in mining, because there are producing microcaps out there at the moment that are just being treated as though they're still out there with a pick and a shovel. But I think there's lots of sectors that you can look at.
Yeah, I mean, what was interesting before the pandemic, we had lots of fund managers, mainly mid-cap, who wouldn't touch things like oil companies, mining companies. They said, just to be honest, I don't know what the price of copper is going to be. I've got no idea what the price of oil is going to be. Quite honestly, I don't need to take the risk. I'll just buy another technology company or some other engineering business or whatever. And that was absolutely fine in those days. And I say in those days because I don't think they're going to come back. Until suddenly, last couple of years, they've been absolutely carried out in performance terms. All those guys who said all those new energy stocks, don't get me wrong, I think we need to invest in new energy, but they've been absolutely carried out by ordinary businesses generating obscene amounts of cash, right? So coming forward now, Woody and others, basically what you're talking about is people beginning to say, perhaps I need to be a little bit more thoughtful about what I'm doing with my clients' assets. It's not just about buying a few companies which go up. You need assets which are resilient, and resilience means actually you're investing in companies which are characteristics differently. If you did have a lot of Russian gold mining companies 2 or 3 years ago, and of course the invasion of Ukraine came, you did lose overnight, and some FTSE companies as well, 80-90% of your money just overnight, right? But if you had a bit of British aerospace, you had something which went up 40% at the same time. We need diversification. People are beginning to learn that. And the way you get diversification isn't just by buying different types of engineering companies, but buying energy companies, mining companies. And so coming back to it, basically all fund managers are going to need to learn that they need to think about mining companies as part of the diversification. I can't tell you what the energy price is going to be necessarily. I've got some good guesses, but that's part of the diversification. They do something different when an unexpected event happens.
Yep.
Yeah, look, I'd agree with that. I mean, because, if you look at some of the names like a Rio, for example, it's been a great performer the last couple of years, absolutely flown. Now it's starting to just sort of have a bit of a stabilisation period. But there's some great companies in that small cap range. I was just thinking as you were talking, like a Kenmare, net cash balance sheet, 10% dividend yield, basically nailed on for the next sort of 2-3 years. Really good company. Camel, good quality business. Net cash balance sheet. And then you look at some of these projects that are out there, that, again, like we talked a bit about Rainbow, but I honestly think that's the bottom for that stock now. Like, he gets that pilot plant going, that flies, it doubles in 6 months. There's some really good quality businesses, and you can just sit there clipping a 10% yield, and then sooner or later, as you say, people will realise that actually this stock is really cheap at 1.5 times EV/EBITDA, and I need to step in and buy it. But you've been sat there for the last 18 to 24 months taking 10%, which isn't bad.
I mean, just to add something, I mean, Kenmare has over 100-year mine life, right? Over 100 years, right? On a PE 3.2.
Yeah, agree. Yeah, great business.
It's extraordinary how many fund managers, in certainly the ones that sit on panels that we all sit on, voting panels and such like, where there'll be a mining company that gets nominated for, AIM Company of the Year or Transaction of the Year or PLC Awards or whatever. And we look round the table at these fund managers and say, I don't invest in natural resource stocks at all. I said, well, aren't you interested in the green world? Because all these companies make the things that you need to make a green world that you seem to insist upon. And it's extraordinary. And every year it's the same. And it's Sentiment got nominated for something, and one of the fund manager of a very, very large $1 billion. What do? It's frightening. So I think there's a we all know, but we don't know how to articulate, I don't think, very well as the mining industry itself does need to. The ESG slide's gone from the back of the presentation to very close to the front in all the presentations. We've seen that move in the last 4 or 5 years, but as a PR job, the industry is still pretty rubbish.
There was a point raised on the lithium discussion earlier today around lithium being slightly more in the public sphere now, with electric vehicles, with all the media coverage that it can get. Do you think and if lithium could be the commodity, or lithium companies might be the ones to do this PR better because they're just closer to that EV story, they're closer to that wider recognition, people going, oh yeah, lithium, isn't that in a battery? Is going to take another spike in the lithium price and another bull run there to bring that into the public sphere a bit more and help that message?
Well,
or is it all?
I think
too technical.
I think lithium, rare earths. I mean, no one knows what all the rare earths that go into a magnet.
That's getting very niche. Yeah,
but most people don't even know that magnets are very important for electric vehicles, and so there is a sort of a perception and a reality that of how much education the general public needs. There was a very interesting video by one of the universities that I actually sent to the headmaster of my son's school, and I said, you should make sure all the students watch this, because it's all about mining and why you need to mine this stuff to make electric vehicles as a sort of kind of starter for 10. And the headmaster emailed me back. He was absolutely gobsmacked because he didn't know any of this. And, and he said, I've got a school full of increasingly woke kids that think everything to do with mining is the devil incarnate. I was, well, there's the problem.
Yeah.
But I think coming back to lithium, I mean, it does introduce another thing, which I think as investor managers, we need to be very wary about. And that is, if there is a dollar shortage, I think there will be going forward. They're kind of squeezing inflation out of the system, quantitizing the rest of it. Some countries are going to run out of money, right? So hard currency I'm talking about. And we're seeing, of course, in lithium, that our friends in Chile are now saying that they think they own more of the Chilean lithium. So again, there's real tensions here, which might be difficult for the miners in Chile. But of course, if you've got a mine in a relatively safe area, of course, the risk-reward ratio just gets hugely better as a result of all this, right? So coming back to it, there are negatives, but there's really big positives on the other side of this.
Yeah, and I'd say as well, the reality of it is firstly from the buy side perspective, your investable universe is huge, right?
Yeah.
There's so many fund managers I speak to that just don't have the time to dig into the detail of some of these names, which depending, you can say bad excuse, good excuse, but I speak to a lot of fund managers, and a lot of the companies I cover, or few, have got disclosure which could improve, right? How can I pull apart this set of accounts? How can I pull apart these operational sort of metrics easily? And quite a lot of PMs I speak to just say, look, I haven't got the time for it, I'll move on. And then the other element of flipping it the other way around is there's not too many brokers left, right? You know, Nemis pulled out of mining, don't do it anymore. You know, there's us, there's Peels, you know, there's some of the specialists who are brilliant, but, you know, they're not on the MiFID list, so therefore they can't get through the door. You know, it's really difficult. And then, you know, some of the bulgy banks, you know, UBS's or whoever that may be, they don't get anywhere near small cap mining. So, you know, there's only there's a good number of stocks I cover where it's me plus one that are the research analysts. And, you know, therefore, you know, if we're spread too thin and we can bang the drum as hard as we can, but, you know, if there's not 5 or 6 or 7 of us picking up the phone and ringing fund managers and saying, you need to look at this stock, it's very hard to get through the net sometimes.
I mean, you've got to remember the market has a good sense of humour, really. And so what it's done is it's just absolutely taken everyone out at the bottom. Yeah. You know, the risk-reward ratio is beautiful, right? You know, the UK market will outperform, small caps will outperform, probably the mining stocks will be some of the best performers of the micro caps. You know, the risk-reward ratio is fantastic. And that's what changes people's behaviour, of course. You know, as they underperform, eventually, when they get quite expensive, they might buy some. Yeah. You know.
We had a lot of interest in the REAs, you know, like the last couple of years when it's flown. Yeah.
For me, I think this is why the turn, when it happens, is hard for people to time. But in truth, is that a very underowned sector, you only need very small improvements to change. And I think that's the point that Gervais is making. And I don't disagree. I think that is correct. I think in my world, everything's about the flow of money. Are people prepared to put money now or something else? And when will they change? And really, people put money in something that they think they're going to make money. That's a reality. If you think you'll lose money, you're not going to invest in something. Nobody invests in something that they think is a sure loss. Yeah, like, I don't know anyone. So, and that timing is what is a function of a number of things. It could be a commodity price move. It could be anything. But it needs to get into the consciousness of someone that sector is doing well. Okay, and then people look at it. Why do people buy Bitcoin? Most people don't even know what it is, genuinely. Okay, and really it's because the price of Bitcoin was going like that. You didn't need anything. You just had to pull any quote and you see it's going up every day. So people buy it. I'm not saying that's the same mining sector, but what I'm saying is that you need something to get people back into the space. And once that happens, the momentum will build itself. And I think we're kind of waiting.
Yep. You need the good projects though. Like think of a few London-listed companies like Cornish Plays and things like that. They had great momentum, great oversubscribed initially, you know, because everyone wanted a UK sort of battery metal story. But then these things plateau and they need more capital, and then it takes time. And I think that the duration of the mining projects can be what sort of grinds down investors, right?
Yeah, and well, all I was going to say on those ones was, yes, I mean, you know, fantastic that a British company based out of Cornwall can raise 40 or 50 million quid at IPO and the share price goes ballistic and fantastic. But also the reality is they were the first one to stick their hands up saying we don't know how much the CapEx inflation now is going to change our model. And we don't know how much anything's going to cost anymore and how much the mine's going to cost or the OPEX is going to go up. And so it sort of suddenly stopped and that ripple was felt right across, especially the small cap mining community. Didn't matter where your project was, everybody's got the same, you know, we're hearing 40% inflation from when they kind of first put the slide rule over a project 18 months ago. 40%, you know, and higher interest rates. And it's difficult despite the whole demand curve thing. And it's a shame, but that's the reality.
Yeah, I mean, there are other factors to worry about as well. I think energy, generally, I think the transition of the energy is going badly. I think we're not getting enough new energy coming on. If you want to build a oil field in the North Sea, you're paying 75% marginal tax rate at the moment. And if you think the UK is bad, you can go to Norway and pay 78, right? So coming back, we're just not putting enough investment into carbon-based energy. And I know we now need to transition away from it, but we're going to run out. And of course, mining companies use a lot of energy, right? So you're going to find that your projects are actually under margin pressure, partly because the cost of energy may go up considerably. But again, coming back to it, we need your products. So ultimately, we need to find a way, and you, in many cases, are better financed than many of the private businesses. So net, you'll be just fine. But there's all sorts of uncertainties coming out there. But the risk-reward ratio, as we all seem to agree, is just wonderful.
I think the other one last thing we didn't really talk about in terms of, which I think has been a big change in the sector, is the cost of capital. So cost of capital has really changed. Obviously, interest rates gone from 0 in the US to 5%. And that is a real pinch. So what it means is that if you think you have a mining project that you can make 10, 12%, right, that no longer may be enough to justify a build. So now you need a project that's a lot better. And I think these kind of things, because it happened so suddenly, a lot of companies that were ready to build suddenly becomes not economic or not really economic. So for me, these are big changes that will play itself out. I don't know whether it's completely played itself out, but it is playing itself out. Do you know what I mean? It's not just the cost to finish it. It's just that if I have a choice of doing that and taking so much operational risk, I might as well just buy US Treasuries and get 5%. That kind of trade. These are the things that, for me, I've been debating in my mind between when do people buy gold in an inflationary environment, or do they just sit on US Treasuries? Because there is an option now. Sure, you're not getting 20% on US Treasuries, even if inflation is 20%, but you're not taking any risk. Do you know what I mean? So that's a trade-off. Now, eventually it'll play itself out. Like I said, I don't know when.
I was going to say, I think fixed income is a nightmare, really. Because in inflationary times, why would you want a fixed income? You're absolutely guaranteeing you're going to make an absolute loss. And when inflation is above, it is in the UK, perhaps in other nations less so. But when you've got negative real interest rates, again, what are you playing at? It's just now I can understand for tactical reasons you might want some diversification, you might want assets which hold up well if there was a market rumpus or something. I can understand all that, but to actually allocate to many of these fixed assets in an inflationary period, I think it will be quite long-term inflation, not all the time, zigzags along the way, but I think that's what's coming. Again, you guys are involved in physical assets. Wonderful. Inflation is your friend. You're in the right place.
Yeah, I'd also say, the interesting thing is, if your returns on a project are going down because your capex has gone up by 30 or 40%, either it's going to go one or two ways. Your cost curve is going to have to get steeper, and the price has got to go north, and therefore, you're incentivized to build a project at $10,000 a ton copper versus 7.5 or 7.5 or 7.7 or something like that, which is probably street average, or you get demand destruction. And I don't think any of us want demand destruction because we can't have it, right? Because if we want to get net zero, we can't have demand destruction. We have to have demand expansion. So therefore, one way or another, I feel quite constructive on prices, particularly of those, those commodities which are linked to the transition. Like, yes, lithium's halved, but long term, the demand is really quite compelling. Copper, it's cheap here. I think it's pretty cheap. But near term, I'd be buying gold. And I think you can see that in your ETFs. You can see it, and you can see some of the gold companies are hedging, right? They're hedging now, and they're hedging at 2,100. So, in the spots, what? Just dip below, yeah,
just like below 20, 30.
Yeah. So, you got some nice upside there. But yeah, near term, I think the golds, but medium term, I think those base metals and some of those transitions are going to fly.
If there was a market setback, though, remember, 2020, March 2020, gold went down with everything else. It went everything out, So when people need cash, it takes a little while sometimes for these things to get going. So
then it flew, though, right?
Yeah, it did. Oh, massively, yeah. Obviously, you were able to buy, polymetal and things at amazing prices. That's the opportunity. Absolutely.
Okay. Do we have any questions for the panel at all? Yeah, gentleman at the back. Another one here.
Say AIM is cheap, but the market can remain irrational longer than you can remain solvent. So who cares? Because ultimately, the retail investor can literally buy anything in the world. So why would they buy? There will be some mining stocks that will do well because fundamentals do well, whatever, and some bigger investors will buy them. But why? How? I can't see how AIM mining. I don't see who's the buyer. It's about supply and demand of the stock. So who is actually going to be the buyer?
Yeah, I mean, I think ultimately the institutions we buy, that sounds radical.
Because of ESG, right? So, I mean,
No, the ESG is better in small companies. You can actually speak to people, you can engage with them. But coming back to it, the whole point is, if you don't make any money in the larger mainstream market and everyone's just ludicrously overweight this sector, you need more smallness, right? And now, you don't need much more smallness. I'm not saying we get rid of big caps entirely from your portfolios. You'll have still loads of them. They're producing no return, largely, right? And you just need to actually then eke down to those little specialist seams where you make absurd returns. And as I say, I think the returns you're going to be making for many of your companies, and you know that, the valuations are kind of criminally low as it is at the moment, are just going to be wonderful. So once you get that momentum, which Woody was talking about, you just get all these others, jumpers on, camp followers, the whole bloody lot of them. And as I say, by the time we're talking in 20 years' time, institutions will be overweight microcaps. But it will take 20 years for them to come. And between now and then, boy, small amounts of money move share prices an awfully long way.
fair enough. Thanks.
Gentlemen there.
So thank you for your comments. Basically, my company has background in coal, and so we have seen in the market that a lot of the large operators tend to, instead of pursuing new projects, they give capital back to the shareholders, and so the capital is basically leaving from the sector. So what do you see, and how do you see this process evolving, and what needs to happen for the large, or let's say mid-large operators, to keep the money and basically to instead expand and grow the new projects instead of returning it back to shareholders? This basically has been, as we perceive it, driven by the higher risk of the new projects. And so what needs to change such that the operators decide to develop new projects instead of giving the money back to shareholders?
Great question.
It's a capital allocation call. And so I think with mining companies, so the real reason is because they blew up many times in history, right? They invest in projects that blew up. So shareholders are like, please don't try that game again because we're going to fire you. So that's really the trade-off. And I think eventually, the way I see this game play out, everything is about returns. It really is. If they can demonstrate a project that can give them an unbelievable return on investment, right, they'll get the green light to build it. But if it's marginal, or if it's not, according to the market, it's not a great project or not that great, then they wouldn't. And I think that this is why the way I see the market develop, it's down to pricing of commodities. So as long as these guys are not investing in new projects, supply is not growing. So as long as GDP continues to grow every year 1%, 2%, 3%, the demand will put pressure on the price. The price will move up. Eventually, it'll be so good that it doesn't matter what you're mining, they'll buy anything. But that process takes time. We're basically burning through that phase right now. At the moment, nobody believes the prices are here to stay. So you never invest in a 20-year project when you think you got a 1-year spike. Do you see what I'm saying? That makes no sense, right? So you're waiting for the price to keep going up to a level where you think, wow, this thing's not coming back. At this price, it's a no-brainer, and then the money will come.
Yeah, but then you got other stuff like, BHP, right? They green-lighted Jansen. Everyone said that's the stupidest thing you could do, right? Stupidest thing you could do. And they had a big, round table on potash and, 450's our price, 400's our price. And everyone sat there going, no, the price is 200 and what you're doing is stupid. Was the price goes to 850 and then suddenly the analysts are going, how quick can you bring on the second line?
Yeah.
Right?
Exactly.
And,
so it's the price, right?
Yeah.
Because while the price on the floor, everybody's going to tell the CEO he's brain dead, okay? And if he does that, he's going to get fired. Yeah. So everyone's going to tell him not to do it, right?
But I think it's starting to change though. You've got BHP does Oz Minerals, good deal. You've got Rio buying Rincon, which is that Argentinian lithium thing. There's stuff out there. They're doing deals, small but deal. BHP, and then you obviously got Glencore going for tech, which is interesting. So there's stuff starting to turn, and and the capex is starting to go. 4 years ago, Rio's capex was 5-6 billion. Now it's 10. Right, so and they're investing in projects and decarb and things like that. So at the time, everyone had a fit because they were worried their 10% yield was going to go down. It has, but now they're saying, look, the long-term yield on this thing's 5%, and we'll fund your growth, and we'll maintain a strong balance sheet. So I think the tide's starting to turn.
But I still think there's event risk. We just aren't allowing, we're just assuming that things are smooth S-curves. That's not how the world is. Look at any share price or any market price, it's spiky, right? There's spikes coming, they might be up and they might be down, and there's all sorts of risks out there. Rio's is a good business. Its best part of the business is probably in Mongolia, right? Well, that's a fruity little risk for you, So coming back to it, when you look under the bonnet, it could be we're just suddenly short of ilmenite because the Mongolians changed their mind on something, or they've sent it all to China or something. God knows, right? So just don't take the status quo as the status quo. It's gonna change, and boy, it can change for your benefit as well as for your disadvantage.
So just to follow up, do you see this as a sort of sustaining process, or do you see something like a one-off given how much capital the current operators have? Because we have been at the peak of the cycle, right? So everyone has strong balance sheets, and they either decide to continue growing or to give it back to shareholders. And so what will happen, like let's say in 2 or 3 years, when the balance sheets might not be as strong? Do you think the process of returning capital will continue, or the growth is here to stay?
I don't know where your mine is, but I mean, there's a lot of North African mines in Mali and places. Well, that's a fruity risk too, right? So, what I'm saying is I just don't think the competition is going to be there all the time. And you could suddenly find that it's offline, as it is with the Russian gold as well. So from that point of view, you can find suddenly things can change a lot. South America, I think, is quite risky in all sorts of areas, not just Chile and other places. So I think you can find, actually, that if you have a mine perhaps in a more expensive Western area, you might actually make a lot more money than you can in some of the more exotic locations around the world. It could be the other way around. I'm not saying one way or the other, but there are serious risks out there, really big ones.
Yeah, I'd say the days of the mega yield from the mega caps is over, right? Like we're not going to see a 10% yield out of Rio for a very long time, because they've got they'll have a net debt to EBITDA target of anywhere between 0 and 1, maybe 1.5 if he's feeling really racy and buying something. But the reality is if they're pushing that leverage target up, then the dividend comes down, and they'll push the bottom end of the payout range. So I think. Yeah, it's more. It certainly feels like investment in growth, and it started slowly. Good project coming online, good project, and now they'll start to accelerate it a bit more. So I think we're now in that period of bringing those projects online.
So more M&A coming.
Yeah, I think so.
Good. Okay, excellent. Well, fantastic panel, really interesting, and a round of applause for the panelists.